Hi, I'm Frank Wigginton. Welcome to video 2 in the 3-part video series. If you haven't watched my first video, Retirement Lifestyle Planning Guide, pause this one and go back and watch it first. Then, be sure to come back and watch this one. Today, I'm giving you my one-of-a-kind retirement income planning exercises. I'm going to explain taxes the Frank way and share my annual retirement spending tool. If you haven't already done so, click the link below to download the retirement income planning worksheets and print them off and have them ready. Grab some colored pencils, crayons, or markers to use during the exercise. Be sure to watch this entire video to learn how to use these tools to bring clarity to your retirement planning. In this video, I will share with you the fundamental rule of taxation, how income taxes work, and the difference between average and marginal tax rates. Which sources of income are taxable and which aren't when thinking about retirement income. Then, I will take you through 2 case studies showing you how to build a retirement income. Lastly, I will show you how to map out how much income you'll likely need year over year for the next 20 years of retirement. Be sure to download and print the worksheets to complete them as you watch this video. Then, get ready to bring clarity to your retirement. So let's start with the exciting world of income taxes. There is one fundamental rule of taxation that you need to remember. Are you ready for it? The government always gets paid, right? Can't seem to avoid it. What this means is that if you haven't paid tax on something, you'll probably have to pay tax on it sometime in the future. And vice versa. If you have paid tax on something, you probably won't have to pay tax on it in the future. Knowing this fundamental principle will help you better understand how several of our tax programs work. So let's try a little quiz. What do you think the average tax rate of a person earning $91,000 a year in Ontario is? Is it A, 50%, B, 43%, C, 31%, D, 23%, E, 17%, or F, 10%? Let me repeat the question. Listen carefully. What is the average tax rate of a person earning $91,000 a year in Ontario? Is it 50%, 43%, 31%, 23%, 17%, or 10%? Well, if you guessed 43%, you wouldn't be alone. A large number of people guessed 43%, but the correct answer is D, 23%. The question asks what the average tax rate. The average tax rate of a person earning $91,000 a year in Ontario is 23%. Their marginal tax rate is 43%. The average is 23%. The marginal is 43%. So you may be wondering, what's the difference? Well, I'm glad you asked. Take out your average versus marginal tax rate worksheet and follow along, filling in the numbers as we go through the example. So first off, in the top right-hand corner, I want you to write in Fed plus ON 2017. In the top right-hand corner. Fed plus ON for Ontario 2017 in brackets. Now keep in mind that all the numbers listed here are rounded numbers and not exact. They're pretty close, but we keep them in simple numbers to increase the overall learning and retention. Now, what I want you to do is to think about the ruler there as a taxable income tube. Every time you earn taxable income, you have to pour that into this tube. As you earn more and more taxable income, you fill up more and more of the tube. So let's take a look here at your marginal versus average tax rate. On the money that you earn from $0 to $11,500, you pay 0% in tax. You are in the 0% tax bracket, or your marginal tax rate is 0. So if you earned $11,500, what would your average tax rate be? That's right, 0. Be sure to fill in these numbers as you go along on your worksheet. Now, if you earn from $11,500 to $45,000, you are now in the 20% tax bracket, or your marginal tax rate is 20%. And if you earn $45,000, your average tax rate is only 16%. The reason is you paid 0% in tax on the first $11,000, and then you paid 20% in tax on the next $33,500. So when you average it out, it works out to about 16%. So if you earn between $45,000 and $90,000 of income, you're now in the 31% tax bracket, or your marginal tax rate is about 31%. If you earned $90,000, your average tax would be 23%. That means that on all your income from $0 to $90,000, you paid an average of 23%. So if you earn from $90,000 to $140,000, you're now in the 43% tax bracket, or your marginal tax rate is 43%. If you earned $140,000 a year, well done. Your average tax rate is now 30%. So in the example earlier, where we had $91,000 of taxes, the average was a little more than what the 90% average was. So it worked out to about 23%. But as you can see on your taxable income tube there, that you were in the 43% marginal tax rate. So if you earned more than $140,000 up to $200,000, you're now in the 48% tax bracket, or your marginal tax rate is 48%. And there's a new tax bracket now above $200,000, which is 53%. So any income that you earn above $200,000 is going to be taxed at 53%. So I hope that gives you an understanding of how the average change is different from the marginal tax rate. Many times people think that they pay nearly 50% of their income in taxes. But the reality is we have many deductions that come off our pay stubs, including contributions to the Canada Pension Plan and employment insurance and union dues and pension contributions and healthcare deductions. Those all come off our paycheck, but those aren't taxes. So now what I want to do is take you through two case studies so that you can see how to build a retirement income. So we're going to look at two different scenarios, one as an individual in retirement and one as a couple in retirement. Okay? So the first one I want you to take a look at your retirement income planning exercise for an individual, and we're going to look at Aileen, and I'm going to read you this case study, and just follow along with me, and then we'll do the work together on the worksheet on the board here. You can follow along on the slides and fill it in on your worksheets as we do it as well. So Aileen is 65 and would like to retire from her job as a manager for the City of Toronto. She has worked there for 36 years and qualifies for an unreduced pension of $36,000. Aileen has always enjoyed traveling and engaging in her passions of writing and photography. She owns a modest home in Mimico and takes her two giant poodles for hikes along the lakeshore. She figures she needs about $36,000 a year to cover living expenses and would like another $17,000 a year for traveling and renting a cottage for a few weeks in the summer. Sounds nice, doesn't it? So Kathy has her $36,000 pension. She's got $125,000 in her RSPs. She's got $28,000 in her tax-free savings account. She's got an investment account with $148,000. and she qualifies for $10,000 worth of CPP and $7,000 worth of old age security. All that's on your worksheet there. So my first question to you is, how much money does she need each year? Let's take a look. So she said she needed $38,000 a year to cover living expenses, and then another $17,000 for travel and renting a car. So let's get this up on the whiteboard. Let's use purple. So we have $38,000 plus $17,000, which gives us, what's that? $55,000. She needs $55,000 a year. But what else does she need to do? She needs to cover off her taxes. So she needs $55,000 plus taxes. Following? So the next question is, how much is she short each year? So she's got 55, she needs 55, and she has 36 from the pension. So we take a different color here. So we take 55, that's what she needs. We subtract off the 36,000 from the pension, and that's going to give her $19,000 that plus the taxes that she's short each and every year. Are you following? Hope so. So what other sources of income could she have? Throw these in my pocket here. She could take money from CPP, old age security. She could withdraw money from her RRSPs. She could withdraw money from her investment account or her tax-free savings account. She has a modest home. Maybe she's got an extra room. If she really feels like it, she could maybe Airbnb it, or she could rent out a room to somebody, and that could help to generate some of her income. But for this session, why don't we look at how her income plays out with Canada Pension Plan and old age security. What I want you to do is I want you to grab your retirement income planning exercise worksheet. It's the one that only has one taxable income tube. So if you need to, pause the video, make sure you've got that, grab that sheet, and have it ready. Okay? I'm going to do a sample of this up on the board. You can follow along on the slides as well. So we're looking at a total income of $55,000. So in the top right-hand corner of your worksheet, mark down $55,000 as the target income right here. Mark down $55,000. Now, I'm going to draw out a little sample of this. So we've got our taxable income tube. Okay, and I'm just going to make some hash marks. Bear with me, they're not going to be all measured out. But we'll call this the 11,500. We'll call this 45,000. We'll call this 90,000 up here. And I think that's good enough for what we're doing. So, first off, we're looking for $55,000. That's our target income. That's cash in her pocket after taxes. So, we know that she has a pension. Where'd all my markers go? Oh, right here in my pocket. Look at that. So, let's put the pension in purple. So, we've got pension. We know that that's $36,000. Right? We got that right? Yes. So, at $36,000, What I want you to do is I want you to take the same color marker and I want you to kind of shade in up to about $36,000. And that's pension. Shade that area in on your taxable income tube. On your pension, you have not paid tax on that money. Fundamental rule of taxation says the government always gets paid, so you have to pay tax on that. You pour it into your taxable income tube. It starts to fill up your taxable income tube to give you your $36,000 before tax. So, on the first $11,500, she pays 0 in taxes. On the next $24,500, she has to pay 20% in taxes. So if you want to do that math, you're welcome to, but I've done the math for you. It works out to about $4,000. So her take home is $5,000. $31,000 is her take home from the pension after tax. Next, Canada Pension Plan. So how much does she get from Canada Pension Plan? We'll put CPP here. She gets $10,000 a year from that. So what we're going to do, 36, just above the $46,000 mark. And we're going to fill in that. Now, did we move into a new tax bracket? Yes, we did. So she went from $36,000 in the 20% marginal tax bracket up to $46,000 now in the 31% marginal tax rate. So on the first $9,000 will be taxed at 20% and the last $1,000 will be taxed at 31%. Again, done the math for you. Let's just see here. So that works out at take home of $7,900. Hope you can see that all right. It shows up on your slides as well. Okay. Next is old age security. What color is old age security? We'll make that color red. So old age security. So she qualifies because she's 65. She can now start collecting old age security, and she qualifies for the full amount because she's been in Canada all her life. So she's going to get $7,000. So what we do is we take the marker and we move up and we fill in, and here's the next amount of income. That's all taxable. You didn't pay any tax on your CPP contributions, and old age security is a social assistance program, so you haven't paid any tax on that. You actually haven't paid anything towards that aside from your income taxes. So when you collect it, it's all taxable. The government's got to get paid. So the $7,000 goes into your taxable income tube, and it's all taxed at the marginal tax rate of 31%. So that gives you $4,900 in take-home pay after tax. So, how close are we getting here? Let's just do a quick total. Okay, let's do a quick total on these. We have 36, 46, 55, 50, where are we at? 53,000. 53,000 before tax, giving us 43,800 after tax. Is $43,800 enough money to meet her requirements? No. She's short about $11,200. So where is she going to get the money for that? Well, she can take some money out of her RRSPs, she could take some money from her investment accounts, and she could take some money from her tax-free savings account if she wanted. So why don't we take a look at this scenario? Why don't we say she takes some money from her RRSP because she wants to start shrinking her RRSP so she doesn't fall into the RRSP tax trap. You'll learn about that in the next video. So she takes some money out of her RRSP. So let's say she takes about $6,000. So, has she paid tax on that money? No. So, she's going to need to include that in her taxable income. So, we draw another line here, and here is her $6,000 in RSP. Is she in the new tax bracket? No, she needs to get above 90 to get into the new tax bracket. So that's all taxed at 31%. So that means that she takes home $4,200. I hope you're getting these numbers down on your worksheet. If you need to, pause the video, go through and fill this in on your worksheet. Make sure you're filling your taxable income too, because this will really help you to identify your tax brackets and understand how the different income gets taxed. Okay? So, if we add $4,200 to this, do we have enough money? No. So, the thing is that she's starting to get up and up and up in the tax bracket. So maybe what we want to do is start using some income that's not taxed as high. So, if she takes money out of her non-registered investment account, her regular investment account, that money there is pretty much fully paid on taxes because every single year she's going to have to pay taxes on any growth or income that comes from it. So, what I want you to consider that the money that you withdraw from your investment account, there's nothing for you to declare. You may incur capital gain or there may be some interest or something like that, but it'll be pretty nominal because you have to pay the taxes on that account every single year. In the Retirement Clarity Workshop that we host, we walk you through all the different types of taxes and all the different income sources and how to reduce and minimize those. So we'll get into that at the workshop. But for today, I want you to look at it and say, okay, she's going to have some investment income. Let's go back to blue here. She's going to have investment income, money from her investment account, and it's going to be about $7,000 a year. And that's basically taxes paid. So she's going to have the full $7,000. So now, when we walk through this and we look at it, her totals on this right now are $66,000 of before-tax income when we add all these up, and her after-tax income is exactly $55,000. Is that enough income to meet her needs? Yes, it is. So let's take a look at this for a second. The total taxes that she's paid. Let me grab another marker. So her total taxes, so total tax is $11,000, 66 minus 55, before tax, after tax, is $11,000. This gives her an average tax rate of 16.7%. 16.7% as the average tax rate on this annual income. So each year she can go back and say, okay, well this year I need to buy a new car, so I'm going to need more money. So she can go back and replan on where that money's going to come from and plan to figure out how that money's going to be taxed. But this should give you an idea of how to build a retirement income. Figuring out which sources you bring. You just need to identify which sources are taxable or not and pour those into your taxable income tube. By doing that, then you're going to be able to map out and figure out how much money am I going to need. So make sure you pause the video, go back, make sure you get all these numbers written into your worksheet and have that worksheet to use as an example for when you go out and start working on your retirement income. So, hopefully you're not too tired from all the numbers, and I apologize there's so many numbers, but this is how we start figuring out our income. But stay with me. Let's go through another example, another case study, using a couple this time. grab your retirement income planning exercise that has 2 taxable income tubes. We now need one for each person. Each person is a couple. Okay? So we're going to learn about Sheila and Carlos. And I'll read this as you dig out your worksheet. Sheila, a procurement manager, and Carlos, a supply manager for a shipping company, would like to retire. They looked at their expenses and figured they need about $60,000 a year to cover most expenses, and they'd like to be able to take 2 nice trips a year. They figure that's going to be about $15,000. They figure they will only take a big trip once every 2 years after Sheila reaches 70 and Carlos is 74. They don't have any plans to downsize, but wouldn't rule it out if they were running out of money. So, Carlos has a group RRSP that's got about $196,000 in it, and he's got a regular RSP that's got about $210,000 in it. So Carlos is 63. He's done a good job saving. Sheila has about $175,000 in her RRSP, but she also has a reduced pension, because she's retiring at 60, of $26,000 a year. They each have $28,000 in their tax-free savings account, and they have a joint investment account with $132,000 saved in it. Boy, these guys have done well. They have a house that's worth about $580,000, so they said that they wouldn't rule out downsizing if they needed to. Okay? So the first question is, how much money do they need each year? So we started with $60,000 to cover living expenses, most of their expenses, and then a nice trip each year being about $15,000. So that's $75,000. So our target income, put this in the top right-hand corner of your worksheet, is $75,000. That's their target after-tax income. So we need to find that amount of money. So $75,000, but we're going to have to figure out how much they're going to pay in taxes. Okay? So with Carla's pension, not Carlos's pension, Sheila's pension, being $26,000, how much money are they short each year? So that's 75 minus 26, which would give them $49,000 that they're short each and every year. So let's start with mapping out each income and where it comes from. We're looking for a target of $75,000. So let's get the 2 taxable income tubes in here. I'm going to put them skinny so that they can both fit and we still have room for writing. As you can see, I'm a real artist. My best art is stick people. All right, so let's put some tabs in here. This is 11. We'll say that's 45. We'll say that's 90. Okay, so this is 11,500. That's 45,000. And this is 90,000. All right. So let's start with the income we know that's in there, Sheila's pension. So we're going to start with S pension. And we know that that's $26,000 before taxes. So this works out. You come over here and you're going to say, okay, we're going to make this one Sheila. Okay, so we'll put a great big S for Sheila, and we'll put a C over here for Carlos. So this will be Sheila's, and she's got $26,000. So that's going to be somewhere around here. And this is her pension income. So the first $11,500 isn't taxed, and then from $11,000 to the $26,000 is only taxed at 20%. This means that her after-tax income is $23,000. You getting this on your worksheets? Okay. So now, Carlos has a whole bunch of money in RSPs. So we're going to start using some of Carlos's RSP money. Let's go to orange for Carlos. So we've got C, and we're going to take it out of his group RSP, And we're going to start with, let's say, $20,000. Okay? So what we're going to do is we're going to color in a little bit less than this. So we're going to color in on Carlos's taxable income too. Remember, pensions aren't taxed when you put the money in, and neither are RSPs. Okay? So a group RSP isn't taxed when the money goes in. So he's got that money. So $11,500 isn't taxed, and then from $11,500 to $20,000, so the next $8,500 is taxed at 20%. This gives him $18,250 of after-tax income. Now it's pretty easy to see that 23 and 18 is not going to add up to 75. So let's keep going for a little bit. Let's suggest that Carlos is going to take out another $20,000, but out of his regular RSPs. So Carlos takes out from his regular RSP another $20,000. Okay? So he's going to pour that $20,000 in here. So that's going to bring him up to about $40,000. Has he gone into a new tax bracket? No, he's not. $45,000 is the limit. He's up at $40,000 right now. So that means that it's taxed at 20%. That's $4,000 off, meaning $16,000 after tax. Okay? Now, looking at Sheila's income, Carlos has got a lot more income now than Sheila does. So Sheila's going to take out about $14,000 so that she ends up with the exact same amount of taxable income as Carlos. He's got $40,000. She's at $26,000. So now she's going to take an extra $14,000 to bring her up to $40,000 so that their incomes are level. So Sheila takes from her RRSP $14,000, which gives her an after-tax income, all taxable at 20%, of $11,200. So let's take a pause here and see where we're at tax-wise. Income and taxes. Do we have enough income now? Let's take a peek. Where are we at? So we've got 26 and 40,000. So we've got $80,000 before tax. And what's our after tax? Our after tax, I'm doing the math here for you, $68,450. Call it $68,500 for a round number. Is $68,500 enough to meet their needs? No, it's not. So we're going to need to draw some money from somewhere else. Now, do we want to draw more money that's taxable like RRSPs, whereby we may bump up into a higher tax bracket? Probably not. So we could look to draw money from the tax-free savings accounts, or we could look to draw money from the non-registered investment accounts like we did with Aileen. So in this situation, they only need about $6,500 more to meet their needs. So if, what colors have we got going here? Let's go with purple. If they take from their investment account $6,500, that's pretty much taxes paid up. So they're not going to have a whole lot of taxes owing on that, so we just say $6,500. Now, what we've done here is we've managed to reach at $86,500 of pre-tax income. The after-tax income works out at $75,000, which is what their target goal is. So this works out to total taxes paid. Where's my brown? Here we go. Total taxes $86,500 minus $7,500 is $11,500, giving them an average tax rate of 13.3%. How do you like that number? How would you like to be paying an average of 13.3% taxes and still having all the money you need in retirement. So this is an idea of how to go about building your retirement income. So you have these worksheets, print off as many blank copies as you want, year over year, so that you can use these to help build out your retirement income. This should give you the opportunity to start figuring out how to map income against your taxes and to be able to then figure out how much taxes you're likely to owe, to then figure out how much money you likely need. So, the last exercise that we have to work on is figuring out how much income are you going to need year over year over year for the next 5, 10, or even 20 years. So, on the back side of your worksheet, on the back side of my worksheet, you can print these off however you want, whether you print them double-sided or not, but you have your annual retirement spending worksheet. See that there? What I want you to do is I want you to look at each and every year. There's an example there showing you how to look at it and how to use it, but I'm going to go through the example here. So let's suggest that Sheila and Carlos here took the time to figure it out, and they said, okay, well, we need that base income. So the living expenses, we'll call that in purple, living expenses was $60,000. And their, what I call lifestyle expenses, lifestyle, how do we spell that? There we go. Lifestyle expenses was $15,000 a year. But what about one-time expenses? Ooh, lifestyle should have been in a different color. Oops. Oh well. So we're going to make lifestyle a big blue dot, as that should have been blue. All right. So now let's take a look at, I'm going to put this actually in red, what I call one-time expenses. For some reason, every time there's a one-time expense. Funny how that works. So, one-time expense. Each and every year. So what are one-time expenses? One-time expenses are things like the furnace dies and you got to replace the furnace, or you need to redo the roof, or you buy a new car. These types of one-time expenses aren't something that you necessarily have each and every year, but they're expenses you need to think about and consider when you're doing your income planning. The last thing I want you to do is to say all of a sudden you need an extra $35,000 in income to buy a new car, and you jack your income through the roof and into new tax brackets and have it taxed at super high rates. In the Retirement Clarity Workshop, we go into very great detail about figuring out the annual income and how to manage and deal with one-time expenses when it comes to your overall income. So some of the things are predictable. If your furnace is 15 years old, you could probably guess that you're going to need to replace that within the next 5 years. So maybe what you'll do is in year 2, you're going to put in a one-time expense of, let's say, $10,000 or whatever the cost is to replace your furnace. If your roof is 25 years old, there's a good chance that you're going to have to replace that in the next 3 to 5 years. So on one of those years, factor in, I don't know how much a roof replacement costs, but let's say $7,000 for a new roof. You can do a little research, maybe make a few calls, look up how much these one-time expenses cost. One woman approached me and said, can you help me figure out my retirement income? She had just withdrawn $40,000 from her RRSP to buy a new $30,000 car. She said, and I asked her, so why did you withdraw all the money out of her RRSP? She said, oh, well, every 10 years I buy a new car. My thinking was, if you've known for 10 years that you're going to be buying a new car, could you not have planned your money ahead of time a little bit? So those are the one-time expenses that will come up. So what I want you to do is take a look and mapping out how much money that you likely will need year over year. If your car is 7 years old and you buy a new car every 10 years, year 3, put down under one-time expenses $40,000 or whatever the new cost is for that new car that you're going to buy. Mark that in. Now, you've got those bars there with the income going up the side on your worksheet. So what you're going to do is you're going to use a different color for each one. And you're going to fill in your living expenses on the bottom, because those are always going to be there. You're going to want to make sure that you have shelter and food and transportation and all that kind of stuff. So your living expenses are going to be there on the bottom. Let me just draw in a little chart here so that I can fill it in as we go. So we're going to start with living expenses. That's in purple. Now, living expenses, we go like this. Okay? So that's going to come up to the $60,000 mark. Okay? And then in the next year, you're going to mark that in at $60,000. Eventually, you may want to increase that a little bit to cover off inflation as you go along. Okay? And you're going to do that year over year for the next 20 years. Maybe increasing it, but maybe it'll decrease. If you remember from video 1, we talked about how lifestyle in the first few years of retirement, your costs of living, your activity levels may be a little bit higher as you go through the different stages, and then they tend to taper off as you get older and older. But living expenses really don't change that much. Next, remember we said lifestyle was going to be in blue. Right? So then your lifestyle costs, you're saying, are about $15,000. So that's going to take you up to about $75,000. So what you're going to do is you're going to draw in that color there up a little bit higher. Okay? Just like that. You're going to add that to that total. And then you're going to come across and you're going to look at one-time expenses. So in this case, let's say that we're going to replace the furnace next year. So next year, we're going to replace the furnace and the AC and all that good stuff. That's going to cost us, let's say, $15,000. So then you're going to put that spike in there to take you up to $90,000. And we said 3 years out, so let's get one more year in here. You're going to buy a new car. So we'll put that bar in for living expenses. We'll put that one in for lifestyle expenses. And then the new car is going to cost us $40,000. So that's going to take us from 75 to, what's that, 25, 115. $115,000. It's going to take it way up here. So you're going to have this big spike in one-time expenses. When you start to map it out like this, it'll make it much easier to visually see when the big income expenses are coming. And what I want you to think about and consider doing is to start taking more money out a little bit earlier so it's more controlled in those lower tax brackets and building up the savings accounts just as you would if you were working or and earning an income. I want you to consider taking that money out earlier. So this is what I want you to do on your annual retirement spending worksheet. Take this if you need to. Go back, rewatch what I was talking about here, but work through those sheets and your annual spending, and then every single year you can start then building your income plan for each year in retirement spending. Print off more blank copies of the retirement income planning exercise and use the annual spending worksheet to map out your retirement income needs for the next 5, 10, or 20 years. Now you're ready to move to the next step of planning your retirement. With greater clarity about how income is taxed and where your retirement income may come from, you should be able to begin estimating how much income you'll need. To be sure, watch my next video where I reveal the secrets of RRSPs and TFSAs. Be sure to watch and learn why the majority of Canadians are using these tax programs incorrectly and how you can use them to save possibly tens of thousands of dollars. If you liked this video and found you learned something new, tell me about it in the Facebook message links below. If there's something you feel I missed or you'd like to learn more about, let me know that as well. I hope this has helped bring greater clarity to your retirement.